A chart displaying 20 years of smooth upward returns creates an immediate, irresistible sense of certainty. An investor looks at a top-performing mutual fund, convinced that its history offers a reliable roadmap for future wealth. But that glossy line hides a dark market secret. You are looking only at the survivors that managed to stay alive. Structural analysis of this historical performance data reveals a deeply distorted reality. Behind those polished investment charts lies a quiet institutional slaughterhouse where failing funds silently disappear. Asset management companies do not leave their worst historical mistakes on public display for potential clients to inspect. When an investment strategy crumbles under market stress, the firm moves quickly to wipe away the evidence. The systematic elimination of poor records creates a permanent flaw in public historical records, hiding true systemic risk. This pervasive statistical optical illusion is known throughout global finance as survivorship bias. It occurs whenever historical data automatically excludes entities that fail to survive the entire observation window. By calculating average historical fund returns using only existing entities, financial models artificially inflate industry performance. The actual returns earned by real-world capital allocators are routinely lower than published data, leaving investors blindsided by unseen statistical traps. Consider the harsh mechanics of mutual fund liquidation when an active trading strategy breaks down completely. When fund assets drop below a profitable operating threshold, management closes the fund permanently. Cash is forcibly returned to investors, frequently at the worst possible market trough. Once liquidated, the fund's dismal track record is deleted from popular consumer tracking tools, scrubbing its failure from published historical performance data. An even more deceptive corporate tactic involves fund merger mechanics engineered behind institutional doors. Rather than shutting down a badly underperforming investment vehicle, the firm merges the failing fund into a larger, successful fund. The poor performance track record is effectively absorbed and wiped clean. Investors analyzing the surviving fund never see the drag of that buried loss, making historical returns appear deceptively consistent over long periods. The mathematical distortion caused by these systematic maneuvers compounds heavily across the broad market. If 10 funds launch in a specific sector today and 7 go bankrupt or merge away over a decade, evaluating only the 3 survivors yields a massively false picture. The true probability of selecting a winning fund is dramatically lower than charts suggest. Unwitting investors chase phantom alpha, fundamentally miscalculating their real chance of long-term wealth creation. Academic researchers realized decades ago that standard commercial market databases were providing corrupt signals to investors. To uncover the truth, financial economists turned to uncorrected historical research archives like the famous CRSP database. The Center for Research in Security Prices includes every fund that ever existed, tracking both living and dead entities. When researchers analyzed this unedited historical data set, much of the historic outperformance claimed by active managers completely vanished. The performance gap between survivor-only reports and complete historical data is staggering. Extensive academic studies demonstrate that excluding erased funds artificially inflates average annual mutual fund industry returns by 1 to 2 full percentage points every single year. Over a 30-year investment horizon, that 2% statistical distortion fundamentally alters compounding results, cutting a retiree's projected wealth nearly in half through silent reporting errors. The institutional marketing engine relies heavily on this distorted reality to gather fresh assets under management. Asset managers routinely launch dozens of specialized niche mutual funds simultaneously across various speculative themes. They wait 5 years, quietly execute fund liquidation on the underperforming failures, and aggressively advertise the small handful of lucky survivors. What looks like superior fund manager skill is often just raw luck, filtered through survival bias. As an underperforming fund slides toward inevitable liquidation, internal costs spiral upward, destroying remaining shareholder value. Shrinking assets under management force fixed operational and administrative expenses to represent a much larger percentage of remaining capital. The overall expense ratio spikes sharply, creating a toxic performance drag that accelerates capital depletion. This mechanical death spiral inflicts severe losses on remaining investors right before the fund disappears completely. Tax consequences further compound the damage for taxable individual accounts trapped in these closing vehicles. When fund liquidation occurs, forced capital distribution events create immediate tax liabilities for shareholders regardless of their personal financial timelines. Investors are forced to take unexpected capital losses or premature tax hits at the worst possible time. This structural tax drag further widens the gap between theoretical returns and actual preserved net wealth. Evaluating true portfolio risk becomes equally dangerous when historical data integrity is compromised by deleted records. Key financial metrics like beta and standard deviation depend on continuous performance series across entire market cycles. When volatile, failing funds are systematically removed from data sets, the perceived systematic risk of an entire asset class appears artificially mild. Investors end up constructing fragile portfolios based on severely understated risk assumptions. The psychological trap for retail investors remains deep and widespread across every market cycle. Individuals naturally gravitate toward published lists of long-term winning mutual funds, assuming past resilience guarantees future safety. Completely unaware of the vast graveyard of dissolved funds, they allocate capital to yesterday's survivors at precisely the moment those strategies reach capacity, repeating a costly cycle of buying high and experiencing severe structural drawdowns. Institutional allocators and hedge fund risk officers spend massive resources attempting to look beyond these survival filters. Quantitative teams build complex data pipelines specifically designed to reinsert deleted funds back into historical backtests. They understand that ignoring fund death rates creates a dangerously false sense of security. Without adjusting for survivorship bias, any long-term trading model or allocation strategy is built on quicksand, doomed to fail during crisis events. This structural distortion is not limited to active stock mutual funds. It infects fixed income, hedge funds, and private equity benchmarks. In private markets, underperforming managers simply fail to raise subsequent investment funds, quietly vanishing from broad industry performance indexes. Reporting hedge funds voluntarily stop submitting monthly data the moment losses accumulate. Across every major investment category, published historic return averages overstate real investor results by substantial margins. Understanding fund merger mechanics provides essential strategic leverage for investors monitoring their existing portfolios. When an asset manager announces that your mutual fund is absorbing a smaller, struggling product, it serves as an immediate structural red flag. Executives frequently use internal consolidation to mask persistent outflows or hide failing strategies. Recognizing these corporate maneuvers reveals whether growth stems from genuine performance or administrative triage. Low-cost passive index funds were developed in part to escape the selective survival games played by active fund managers. By rules-based tracking of an entire market segment, passive funds eliminate a manager's ability to hide poor security selection behind clever mergers. Yet even broad stock indexes periodically drop bankrupt corporations and add rising stars. meaning subtle survivorship bias exists even within passive benchmark returns over multi-decade spans. To build true long-term financial security, investors must shift their primary focus from simple past performance charts to structural data integrity. They must analyze expense stability, historic asset flows, and the complete mortality rate of funds launched within a given asset class. Looking at the total universe of vehicles started 20 years ago rather than just today's survivors provides a realistic understanding of true historical risk and expected returns. The global financial system's marketing architecture is engineered to showcase success while hiding systemic failure. But lasting wealth preservation requires seeing past polished prospectuses to evaluate the mechanical plumbing beneath the surface. The graveyard of erased funds holds the most critical strategic lessons in modern finance. True market history is defined not by the handful of celebrated survivors, but by the silent majority that did not endure. By eliminating survivorship bias and auditing historical performance data with rigorous skepticism, investors gain a decisive operational advantage. Real financial clarity comes from acknowledging that the market environment is far more unforgiving than standard historical charts indicate. Recognizing the hidden reality of fund liquidation empowers disciplined allocators to construct resilient, realistic portfolios capable of surviving harsh market cycles and preserving genuine wealth across generations.